Even as more and more people are opening Demat accounts and it touched a record high in April, the retail investor participation in shares dropped to a 24-month low. Now, data from April suggests that of the total Demat account base of 11.61 crores, 67 lakh unique retail investors participated in the cash market on the NSE. This is approximately 5.8% of the total Demat accounts in the country. Now, remember, unique retail investor participation is a more accurate indicator as the total Demat account base may include multiple accounts of an individual investor. On the show today, why is retail participation dropping, how are markets positioned, and what are macro numbers suggesting? Joining me at this point in time is Kranti Bhatini, who is the Director Equity Strategy, Wealth Mills Securities. In the studio with me at this point in time, my colleague Krishnakumar and Suyash. Gentlemen, appreciate you taking your time out. Before we discuss the larger question of what's driving inflows into equity market, or rather muted participation there, do not forget to click the bell icon and subscribe to News9 Plus. Coming to you first, Suyash and Krishna, what exactly is leading to a dampened sentiment as far as stock market is concerned? Why is retail participation low?
So Shweta, what happened over the last 15 months or so, the market has been consolidating. The data shows that Nifty only after giving a 15% return in 2020. And remember, after the COVID crash, the market rebounds back and it bounced back about 80%. 2021 followed and 24% return Nifty gave, right? So by 2022, the return started moderating, and year to date, about 0.7% return we have given. In 2022, Nifty gave about a 4% return. So the market has largely been consolidating since the last 15 months. So what happens at a time when the market is moving sideways or is consolidating, that retail participants turn cautious. They are unsure about what's going to happen in the market. So because of these uncertainties, they rather they tend to sit on the sidelines and wait for the things to clear up.
The right opportunity moment.
Yes. So if we even go back to the retail boom of after the March 2020 boom, the Indian markets almost collapsed by 30% in the initial COVID crash, right? And then we saw the bounce back happen. And even the retail, and it was led by retail participation at that time, because see, people were sitting at home, right? They were spending less, and reduced spending means they are saving more, and when they are saving more, your investment increases, right? And then a lot of new age platforms were popping up all the time. People like social media was driving the agenda of putting your money in a safe place or investing in markets. And then the only way the market was going was up, right? So regardless of what sort of experience you have in the market, or regardless of your understanding of the financial space, you were making money. Now 2022 comes around, the market starts consolidating, and we see, so the weak hands, as we call the retail participants, they started getting jittery, right? And they started, at every opportunity, when there was a bounce back, they would sell their positions to lock in that profit, to, insulate themselves from that uncertainty. Whereas the smart money, the institutional money, as we called it, kept on buying, because they are not focused on the price of a stock. They are more focused on the valuations or the future prospects of a country or an industry.
Okay, so I want to come to retail, institutional participation in just a while from now. But from what I'm hearing, Krishna, is that the momentum post-COVID seemed to be now muted at this point in time.
Right, and for valid reasons. What is happening is that you're looking at the stock market being continuously uncertain. And then you have fixed deposit rates, which have remained solid and stable at 7 to 7.5%. Gold giving you good returns. You have other asset classes guaranteeing you better returns at this point in time. And at the same time, if you look at the mid-cap index, the BSE mid-cap index and the BSE small-cap index, where retail investors in India usually invest in. Yes, off late they've started investing in large-cap, funds and large-cap stocks. If the BSE mid-cap and the BSE small-cap index, is down by 4%. And, so which means that a lot of retail investors are already sitting on losses. So while they have taken the trouble to open a Demat account, and that's the reason why you're witnessing a record high Demat accounts, more than 11.5 crore Demat accounts in this country. So they've gotten themselves the ability to trade in the markets. But after getting that, the situation in the market is such that they've had to pare down their own activity in the markets. Look at the primary market. it was, so far this year, you've seen about 6,000 crore rupees being raised by 5 companies. That number last year was nearly 60,000 crore rupees. So there are very little IPOs to invest in, and the markets are volatile, the returns are going down. So, the investor is, but in the meanwhile, if you look at it, in the MF industry, the mutual fund industry, 40 trillion rupees of assets under management. And you have, 91% of mutual fund accounts belonging to retail investors and not institutional investors. So the mutual industry, they continue to have their faith in. It's like saying that I'll get a license, but I don't want to drive the car myself. I'm happy being in somebody else's vehicle, being driven around. That's the situation as far as I can understand, as far as the retail stock investors in India are concerned.
Okay. Kranti, do you agree with that analogy put forward by Krishna? What explains the contradiction? High Demat accounts, low retail participation. What exactly is driving, Demat account holders from not participating, or rather pulling back their money?
Yeah, I completely agree with Krishna. Just to add the points, what Krishna and you all discussing, price changes the perception of the people. So whenever there is a price trend which is into the negative territory, the retail investors' participation tend to come down in the market. And also, just to add a couple of points, as the new age technology platforms that emerged in last few quarters and last few years, we can say, the opening of Demat and trading account have become very easy. It's just a click off from the desktop, just validating the Aadhaar and the other details through a OTP. The account can be opened in 5 minutes and he is ready to trade. So that created equity cult in India, and the more number of accounts getting got registered in last 24 months. That's where we observed and witnessed the surge of number of retail accounts that kept on going up in India. While coming to the active participation, the markets are in a consolidation phase. There is a greed and fear factor. So earlier, whenever the markets goes up, everybody were making money. So investing become very easy for everyone. It seems to be there is free money available in equity market. That's what the saga and that's what the talk of the town. It was there on the market. Right now, one need to understand the company. One need to understand the dynamics of the equity market. How does it works? So when the price changes, when the portfolios get into negative territory, the fear factor that get into the picture for most of the retail investors. That's where the number of active accounts have been kept on coming down. And if the consolidation prevails for more time, you can see the active participation may come down. But one thing is right now, of course, right now the investors are becoming more informed right now. The information flow is very much high. So we can see this change, the change or reduction in the number of active accounts may go up in the coming days. But more of that, the percentage, if you see, it's a huge number of accounts that got added in India historically in last few years. That's the reason when you compare with the number of accounts opened versus active accounts, the percentage looks very high between the active as well as number of accounts got opened.
Okay. I want to also understand from you and perhaps get a lowdown of stocks and sectors that individual investors have nibbled at or have dumped during the last quarter or the last couple of quarters.
See, one thing is when a new investor comes, okay, the quality companies on the bourses, on the exchanges, okay, on the market, they tend to comes up with a high price. So the retail tendency of a retail investor is, okay, they want to experiment with a new companies or a mid and small cap companies they want to start. Nobody want to predominantly, I'm talking about the as we interact with many number of investors on a regular basis, the tendency is many people want to trade immediately and they want to make quick money from the market. That's what the retail psyche or the attitude of the majority of the investors in the market who are coming into the market. So when the quality ones are concerned, they comes up with pricey. Okay, the quality stocks are just these are not stock recommendations. Just to name a few, if you want to buy L&T, it is available at 2,200 rupees as on date. Reliance Industries about 2,000 rupees. So these always the quality stocks, HDFCs of the world, they comes up with the price. Whereas the mid and small cap companies, the penny stock companies can be available at a very small price, very small price. And the retail tend to buy, ended up buying in these stocks because of the I can say not fully complete information, but the small or the the small information what is available in the market, and they ended up buying in this stock. And when there is a consolidation in this space, these stocks get into a back burner, and that's where the activity levels that will come down. And
Okay.
one thing, Shweta, one need to understand: equity investing is not a macroeconomic cycles, interest rate cycles, which tend to be on a longer term. So until unless these investors witness these kind of long cycles, okay, they don't understand how exactly the market works.
Okay. Do you know, interesting dichotomy, and we were talking about institutional investors and foreign institutional investors, in fact, and interesting figures there. Let me quote them. In last 9 trading sessions, the net FII flows have been to the tune of 27,000 crores, nearly $3.3 billion. So while there is a great momentum and thrust there, a retail participation within the country is muted. How do you explain this contradiction?
So Shweta, we also need to understand that domestic institutional investors, while foreign institutional investors remain net sellers throughout 2022 and till about February of this year as well, like they have only turned net buyers since March of this year, right? Domestic institutional investors, on the other hand, continued providing support to the market, right? As the argument goes, a retail investor looks at the price which is next to the ticker symbol, whereas an institutional investor, they are looking at the valuations of the company, the future prospects of the company. And when we are talking about foreign institutional investors returning back to the Indian markets, we are seeing green shoots of recovery, like the macroeconomic numbers are suggesting that the services activity is picking up. It has been picking up for the last 24 months. Manufacturing activity has been on a rise. The demand is there. Inflation seems to be under control. So Indian markets itself seems very well positioned. On top of it, the US Fed is expected, or it's the last rate hike was supposed it's said that it was the last rate hike.
Expected to be the last hike, yes.
What happens is, let's say I am a foreign American investor. I borrow $100 from a bank in America, and the interest rate, let's say it's 7%. Now I translate that into INR and I invest in the Indian markets, right? Now, if the interest rate over high, my opportunity cost, like I have to pay back that 7% to them. So even if I was making 15% on top, like the Nifty was surged to 15%, I have to pay back 7% to the bank in America. On top of it, there is a currency translation also happening, right? 7 to 8% the rupee declined last year, right? So there are not much returns. In a low interest rate environment, they can borrow that money at a cost of, let's say, 2%, come to Indian markets where historically we have been giving a CAGR of 12 to 15%, get that 13% of extra returns.
But as you pointed out, the data, and we are going to pull up some data there and play that for us, the market is consolidating. So we're not expecting that sort of return in the long run or in the short run. So the faith essentially is in the macro data that's coming up.
I mean, the recovery, like we are seeing certain, the data is pointing out that India is on a recovery path, the data, and the market is obviously forward looking, right? So foreign institutional coming back, say retail investors, they are not trend setters, they are followers, they follow where the smart money goes, right? Yeah. So we will see initially, like this is a juncture where I personally feel that, retail participation is only going to pick up as a macroeconomic picture of the country continues to improve.
Right. Yes, I want to be the devil's advocate for what he's saying. Yes, retail participation in India's stock markets, retail participation in buying of financial products, the untapped potential. 6% of India invests in an insurance policy even today. 2 to 3% of India invests in stock markets. 2% of India invests in stock markets 20 years ago. 20 years down the line, still only 2% of India invest in stock markets. Yes, the insurance numbers have grown much better as compared to stock market numbers. My concern here is that the faith of people in where they want to put their money. You're talking about a country where people still love burying money in their backyard or putting it, locking it up in a safe. They don't want to part with their money with another institution. The faith in banks itself has been built up over a period of time to even people to go out there. You're talking about Jan Dhan accounts, making more people bankable. But in that strata of society which invests in stock markets and financial products, that strata of society hasn't expanded in the last 2 decades, and that to me is the problem. And although you have avenues to participate in the stock markets, like you have multiple apps that they can, with which just a couple of taps you can invest in the stock market. Wasn't the case before. You could never invest on your phone in the stock market, and today you can. So while access is great, what is the cost of it? And as you're talking about, the price matters. And my concern here is that the faith of people to invest in stock markets in an uncertain, the VUCA world that we live in, I hate using that cliche, volatile, uncertain, complex and ambiguous. In that world where every financial investment doesn't seem to make sense, how can you expect the retail investor to have faith and wanting to go out there and not part with his money? At a time when job security is problematic, job availability is problematic, you have the macro factors, but the kind of factors that would push, like he's saying, the retail investor will follow when he sees great FII inflows, when he sees great domestic participation.
Absolutely, and that is happening. And I want to understand from you, Kranti, what is driving faith of retail participants in the markets, both foreign and Indian? Why are they investing at a time when retail participants seem to be jittery, wary, pulling back their money? What is the faith in data or the numbers? Is the faith forward-looking? Where is the faith emanating from?
See, one thing is in the medium to short term, there are some blips, there are some headwinds in the data that's coming where after 30 years later, Federal Reserve have been increasing interest rate at an unprecedented manner. We were at a zero interest rate policies just 2 years back, beginning of the pandemic. And today the interest rates in US are around 5%. So there is an unprecedented rise in the interest rates in US that created a lot of liquidity squeeze across the globe. While coming to India, and also that caused more than 1 lakh crores exit of money from Indian markets in past 7 to 8 quarters. If the retail participation is not there, markets would have been somewhere. But what's happening right now, we have to see is what driving the market, where the faith is getting derived in the market is the macroeconomic story. The larger, greater picture of India is completely rosy, and also the GDP numbers and the tax collection data. Look at the GST data that has been coming. Last month, in the month of April, there is a collection of 1,87,000 crores. That is the kind of tax collection that has been happening in India. So the greater picture is good, and also if we expect good monsoon in next couple of months, RBI, if the inflation eases further, RBI recent monetary policy, when the interest rates in US when they are going up, whereas in India, RBI have taken a pause, rising the interest rates. So these are all the macroeconomic factors. That's giving an indication, a positive look on India. That is the reason Krishna and other
Suyash.
gentlemen over there, he mentioned that the markets are always forward-looking animals. They try to discount the good things that are coming to witness over a period of time. And one thing, Shweta, one need to take into cognizance.
We seem to have lost you, Kranti. We'll try and get you back. But I think interesting points coming in there. As far as the macroeconomic picture is concerned, Kranti says it's looking rosy. We just briefly touched on it. Inflation seems to be under control. Growth is in the range of somewhat between 6% to 6.5%, according to various rating agencies, Indian government, World Bank, etc. Also, manufacturing is looking good. PMI numbers are looking great. So it is painting a rosy macroeconomic picture.
Yes, Shweta, definitely. The macroeconomic numbers are suggesting that there are certain green shoots of recovery. Back in from late 2021 to 2020, there were a lot of uncertainties. The geopolitical tensions were there. Inflation was a big concern. COVID always was lingering around. So there were a lot of problems, a lot of uncertainty, which were making the, again, weak hands jittery, right? It was the institution, at least the Indian institutional investors continued providing support through that rough phase or a rough patch, and domestic institutional investors, again, they were looking at the broader valuations. The valuations were attractive and are like seemingly attractive even now.
Okay. Okay. Krishna, I think green shoots of recovery, and to add to what I think Kranti also pointed out, which was interesting to me, is that without retail participation, you couldn't have seen the kind of growth we've seen, and you couldn't have seen the kind of stability we've seen in the past couple of quarters for that matter. So while retail participation is muted, 24-month low right now, it's been an on and off trend, and it will be better next quarter, and this is not the data
absolutely.
that we should depend our long-term view on.
I agree with the overall optimism, because let's face it, we are in the Indian economy, most populous country, fastest growing major economy. None of these factors change, which means that we're in the growth path one way or the other. It's all a question of how soon we get to the kind of milestones we want to get to. $5 trillion economy, $10 trillion economy, all those numbers are staring at us because of the kind of growth we're witnessing over here. So there is no question that the average Indian has confidence in the Indian economy. Now we're talking about a section of the Indian economy called as the stock markets, which is seen as like a barometer of the economic confidence of the country. And in this case, the problem is that the stock market becomes a barometer of the business community's confidence in the Indian economy, and not necessarily the common man's confidence in the Indian economy. So whereas the common man's confidence in the Indian economy is witnessed in the amount of gold that's being bought, in the amount of fixed deposits that are going up, in all the stable investments. Bear in mind, because debt funds have come under a scanner now, because debt funds are not a safe investment anymore, because you have capital gains tax to be paid on that. So the number of fixed income safe investment avenues have been shrinking in an extremely volatile, uncertain world.
Okay.
And when you have lesser volatility, lesser uncertainty in the future, perhaps by the end of this financial year, I'm guessing we can see a double, triple bounce back, because that's the kind of numbers. Because you're talking about 11.5 crore Demat accounts and so much lack of engagement that they are like, all right, we're on with this, and they decide to start participating. You will see these numbers shoot up like crazy. I'm hoping for that day. I'm waiting for that day. But things don't really look good at the moment as far as that confidence level in India's capital markets is concerned from the common man's perspective.
So that confidence does come from formalization of the market, and we saw the entire, after the Adani saga, there was a big talk about, how much corporate governance, there should be certain standard of corporate governance also. So with formalization, the confidence definitely grows, and it's probably a process that, stretches to a decade or two.
Right. Okay. I think Kranti is back with us. Kranti, what's your view of 2023, short term, long term?
One thing is, just to add one more point before the break, before the earlier conversation, I just want to add, equity market is a place where everybody knows the price but not the value. As these retail investors, they tend to know the value of the market, try to understand the larger picture of India, the participation is expected to go up. With respect to the market, I don't want to give any targets for the market, but what we are witnessing is markets are in a range-bound mode right now. One significance one need to understand is in the last 4 quarters, Nifty came down below 18,000 levels nearly 9 times. Whenever it came down below, there was a panic in the market, and also it used to create a lot of fear among the investors. Even the active investors who are there in the market and who witnessed more than 5-6 market cycles also, there was always this the fear factor plays. But markets are so resilient in India. Right now, today, we are back again at 18,300 today in the market. So Indian markets are proven time and again they are resilient and resurgent markets.
Fair enough.
Coming to the point, as you asked, how the markets are looking forward. Once the Federal Reserve gives a rate cut pause and pause to this rate hiking, and once the Federal Reserve take one rate cut, okay, that's where the money is going to come back to India, and Indian markets are positioned in a better way when you compare with the global peers.
Right. I have a question to ask here. Specific, it's a very micro question. You're talking about all the big stuff. The fact of the matter is that the BSE mid cap index and the small cap index are giving returns of about 4% at a time when fixed deposit returns are not below 7% or 7.5%. Do you think the fact, how much of a factor is, the availability of safe investment avenues, steady investment avenues affecting, the average Indian stock market aspirant's ability to participate in the market?
Krishna, your question is a very important question the retail investor need to understand. One thing is mid and small cap companies, okay, by and large, okay, they're always the performance of mid and small cap companies comes up with the capacity expansion and the credit availability with respect to these mid and small cap company. Why we call them as a mid and small cap is they need capital, growth capital to expand their capacities and also to infuse the prospect of the business. Okay, they need more growth capital going ahead. So whenever whenever we are there in a high interest rate regime, these mid and small cap companies, most I'm talking about predominantly, okay, these companies need to raise their working capital, need to raise their debt further. So this is one reason when the interest rates across the globe, when they are rising, the mid and small cap companies underperforming in India. Always because last few years, these companies are fully priced in. This is the one reason that is hampering the performance of these mid and small companies with respect to stock market performance is concerned. But if the investor is a high long-term investor and they understand the dynamics of that particular company, definitely, even though the fixed deposit avenues might be offering 7-8%, but when a investor believe in India's growth story, the largest story, and also the company where he is investing, probably the fixed deposit might give in a medium to short term, they might give better returns when compared to the equity market. But if you see the longer term perspective, always equity market gives much better returns when compared to any of the fixed deposit, fixed income avenues, which looks attractive in the medium
Fair
to short
enough.
term.
Suyash has a question for you as well.
So yeah, the mid cap and the large cap space is obviously volatile, but we were talking that India being so, like at least well positioned from a macroeconomic standpoint, the Nifty, the benchmark, the headline indices have been underperforming its global peers. Like the Indian markets, Nifty only turned positive earlier this month, right? So what's the cause behind this underperformance compared to global peers, that is?
See, if you see 2020-21, Indian market was one of the outperformer in the market in the global peers when you compare. So there will be a time-wise correction also market tend to get into. So if you have to analyze the graph further, okay, in a longer term perspective, Nifty tend to outperform perform. There will be a points and there will be periods where we are going to witness in a short term underperformance also. Just to give a perspective, in last 6 months, one of the reason for this underperformance is one thing is the retail participation has came down, but the hot money which is supposed to come to India that is getting channelized to some other different emerging markets like South Korea have received a lot of money because comparatively,
But
relatively comparable
Kranti,
with
retail
Indian
segment
markets.
is still a very small segment of the entire cash market, right? So really that does not explain that retail push would provide that impetus to the market to rise further.
See, Shweta, you need to understand the data. Okay, one thing is just to analyze, interpret the data. Uh, when more than 1 lakh crores have been withdrawn from Indian markets in past in last 4-5 quarters. Okay, if at all it is the quantum of money that has went out from India when you compare in 2008 where there were global economic crisis, we call it as global financial crisis. When you compare the money, the quantum of money that has withdrawn from India is on a much the quantity is a much higher note. Whereas still forget about the outperformance. we are quite resilient. That is the important thing one need to take into cognizance. Okay, and also when the market is not a not a meter, okay, where we need to compare with every year with benchmark. There will be a time of period. There will be a time-wise correction. There will be a price-wise correction. What we are witnessing is a time-wise correction at this point of time. Uh, uh, when you have to compare these figures with the global peers with respect to the performance of Indian markets when compared with the other markets.
Okay.